Good afternoon, class. Today we're going to discuss Chapter 2, entitled Gross Income and Exclusions. And so we're going to discuss gross income, salary and wages, tax treatment of health insurance, tax treatment of meals and lodging, fringe benefit, prizes and awards, annuity payments, life insurance proceeds, interest and dividend income, municipal bond interest, gifts and inheritances, scholarship income, alimony and child support, educational saving vehicles, unemployment compensation, Social Security benefits, and community property states. And so the nature of gross income. The tax code defines gross income as all income from whatever source derived. And so this means all sources of income are included unless specifically excluded. And so non-cash items are included at fair market value, and barter transactions are also includable. And so if you refer to Table 2.1 and 2.2 on page 2.3, they'll give you a partial list of 2019 inclusions in gross income and exclusions from gross income. So more than 80% of all individual income tax returns filed include some amount of wage income. And so employer typically sends a Form W-2 to the taxpayer. And so a W-2 has your identifiable information on it, as well as boxes. And each one of these boxes will typically have numbers in them, amounts, and they represent something. And so we'll go over each box. So box 1 represents taxable compensation. That's your taxable wages, salaries, bonuses, awards, compensation. And this number normally goes on line 1 of the taxpayer's 1040. And so box 2 reports the amount of federal income tax withheld during the year by your employer and sent into the IRS. Box 3 through 6 report wages subject to Social Security and Medicare taxes, as well as taxes. And so box 8 reports allocated tips. Some employers or jobs, people earn tips as they work. Box 10 reports flexible spending contributions to a dependent care program, if provided. Box 12 reports various forms of compensation, and they're all identified by a code. And so here you had some various codes. Code C is taxable group life insurance. D, E, and G are elective deferrals to retirement plans. B is income from non-statutory stock options. W, contribution to health savings accounts. And DD is the cost of employer-sponsored health care. Box 13 will be checked if the employer is eligible to participate in a retirement plan. And box 14 reports other forms of compensation. Box 15 through 20 reports state and local tax information. I'd like to note that box 14 is important because a lot of employers, they put information that probably should be in box 12, retirement information, they'll put it in box 14, so you have to be very careful about that. So taxpayers may exclude from income the total amount received for payments for medical care or payment for loss of use of a member or function of their body. Premiums paid by your employer for the employee's medical care are excluded from your income. So if your employer covers your medical insurance, it's not taxable for you. Meals and lodging provided by an employer are generally excluded from income if the following tests are met. And so the meals are provided by the employer on a premise during working hours because the employee must be available for emergency calls, or it is limited to short meal periods. Note, under the Tax Cuts and Jobs Act, only 50% of the cost of these meals is deductible by the employer. And so all these items that we're going to discuss, I want to make a note that they're going to change based on tax law. Whenever the law changes, whatever's included or excluded, or the definition or tests that are added. So this is the current status for each one of these items. And so lodging is provided by an employer on premises and must be accepted as a requirement of employment. So it would not be included. So fringe benefits, flexible spending account. So employer-sponsored plans allow employees to set aside pre-tax money for various expenses. And so a dependent care flexible spending accounts allow up to $5,000 each year to be set aside to cover the cost of caring a dependent child or aging parent. Healthcare flexible spending accounts allow up to $2,700 each year to be set aside to cover medical expenses such as dental work, optical care, prescription costs, health insurance co-payments. They can result in significant tax savings for employees. Have a use it or lose it provision. So if the amounts are left after December 31st, employee loses them. So for health care, employers have the option to allow $500 of the unused amount to carry over to the next year, or to offer a 2.5-month grace period after the year end to incur additional medical expenses before the employee loses the balance in the account. And so these, again, like the slide is saying, this is a very useful concept. It just depends on if your employer provides them or not, and this is the tax treatment for them. And so you may exclude certain fringe benefits from gross income, such as employer-paid premiums for group term life insurance, education assistance plans up to $5,250, no additional cost services with exceptions, qualified employee discounts, working condition fringe benefits, so excludable only if taxpayers can deduct items on their own as employees, small benefits impractical to account, like small prizes and things of that nature, tuition reduction, the value of membership to an on-site athletic facility, and retirement planning services. So again, refer to 2.3 on page 212 for a summary of various fringe benefits. This is just a short list. So prizes and awards. So prizes and awards are taxable income. So example, winnings from a television or radio show, door prizes, lotteries, taxable amount equals a cash amount or a fair market value of the property. And so an exception if employee awards are tangible personal property received for recognition of a length of service or safety achievement are excludable. So the maximum amount excludable is $400. So $1,600 if the award is a qualified plan award. So here you have an example of prizes and awards. So Joseph, an employee of Visivus Statutories LLC, receives a clock for 20 years of service. The clock is valued at $1,500. The award is not considered qualified plan award. And so how much is excludable from Joseph's gross income? And so the answer is $400, like the previous slide says. This is because the award is in recognition of a length of service and that is not a qualified plan award property. So annuities. An annuity is an instrument that a taxpayer buys, usually at retirement, in return for periodic payments for the remainder of his or her life. The amount of each periodic payment is based on the annuity purchase price and the life expectancy. Standard mobility tables based on annuitant's current age are used to calculate the annuity amount. And so the simplified method, individuals are generally required to use the simplified method to calculate the taxable amount for an annuity if an annuity payments commenced after November 18, 1996. And so to calculate the excluded amount, the IRS provides a simplified method worksheet. So refer to page 214 and 215 for an example of the simplified method worksheet. So the general rule. Before implementation of the simplified method, the general rule was used for most annuity calculations. And so a taxpayer must calculate the amount to exclude from income by using the following equation. And so here's the equation. And basically, amount excluded would be the investment in the contract divided by annual payment times the life expectancy times the amount received. So employee annuities, again, employers may make periodic payments to retirement plans on behalf of their employees. The payments are not taxable to the employee in the current year if made to a qualified retirement plan. They are not considered part of the investment when calculating the exclusion ratio. These are employers' payments. And so here we have an example. Den has saved $750,000 in his retirement account and uses it to purchase an annuity. His annuity equals $4,800 per month, and the standard mortality table shows he is expected to live 19 years. How much of Den's retirement is excludable from tax each year? And so assume that Den is required to use the general rule. And so again, this is the calculation for the general rule. And so you have the investment in the contract with $750,000, which is represented here, $4,800 per month, 12 months in a year, and this mortality expected to live 19 years. So that's a life expectancy of 19 years. And then the amount received, that's the 4,800 times 12 months. That's identifiable here. And so once you calculate this part of the equation, it'll come out to 0.685 times 57,600, which is 4,800 times 12. And so his annual exclusion will be $39,456. Life insurance proceeds are excluded from gross income if proceeds are paid to beneficiaries by reason of death of the insured. So if proceeds are taken over several years instead of a lump sum, the insurance company pays interest on the unpaid proceeds, and the interest is generally taxable income. And so here it's just saying that a net amount for life insurance policy for the death of a loved one, you won't have to pay taxes on that, but you will pay taxes on interest if you choose to receive installment payments, and it gains interest. And so Karina dies on June 15, 2018, and leaves Dan, her husband, a $500,000 life insurance policy, the proceeds of which he elects to receive as $100,000 per year plus interest for 5 years. In the current year, Dan receives $105,000. And so $100,000 of the proceeds plus $5,000 in interest. So how much is taxable to Dan in the current year? And so Dan must include $5,000 of interest income in his gross income calculation. The face value of the $100,000 is not taxable. And so he's being taxed for just the interest amount, because he elected to get the payment spread out over 5 years. So early payment of life insurance, also known as accelerated death benefits, are viatical settlements, are excludable from gross income in the following situations. A terminally ill or chronically ill taxpayer collects early payout from insurance company, or a terminally ill or chronically ill taxpayer sells or assigns policy to a viatical settlement provider. Terminally ill patient must have a certification from a medical doctor stating that he or she is reasonably expected to die within 24 months. Chronically ill patient must have certification from a medical doctor stating that he or she is unable to perform daily living activities without assistance. If a policy is transferred for value, all or part of the proceeds may be taxable to the recipient. And so when a transfer of value occurs, proceeds at the death of the insured are taxable to the extent they exceed the cash surrender value of the policy at the time it was transferred, plus the amount of insurance premiums paid by the purchaser. So an exception, policy providers are not taxable if the policy is transferred for a value to any of the following: a partner of the insured, a partnership in which the insured is a partner, or a corporation in which the insured is an officer or a shareholder. And so, for example, Bianca transfers to Yvette an insurance policy with a face value of $25,000 and a cash surrender value of $4,000 for the cancellation of the debt owed to Yvette. Yvette continues to make the payments, and after 3 years, Yvette has paid $1,500 in premiums. Bianca dies, and Yvette collects the $25,000. How much must Yvette include in her gross income? Would this answer differ if Yvette and Bianca were partners in a partnership? If so, why? And so in this situation, Yvette must include the $19,500 in her gross income. And so that's the $25,000 less the cash surrender value of $4,000 for the cancellation of a debt owed to Yvette, less the $1,500 Yvette is paid in premiums. And so she'll add the $19,500 to her gross income. If Yvette and Bianca were partners in a partnership, the entire proceeds, the $25,000, would be tax-free. Interest and dividend income. If the total interest is more than $1,500, it must be reported on Schedule B of Form 1040. The fair market value of gifts or services a taxpayer receives for making long-term deposits or opening an account is taxable interest income. And so interest is reported in the year is received by a cash basis taxpayer. U.S. saving bonds. So you have Series EE, Series HH, and Series I. Series EE bonds are sold at a discount before 2012 or at face value. They increase in value over their life, and so the increase in redemption value is generally taxable when the bond is redeemed and interest is paid. And so a Series HH bond no longer issued by the Treasury as of August 31st, 2004, but the bond is issued before that date are still outstanding and pay interest semi-annually, and they were issued at face value. And Series I bonds do not pay interest until maturity. Earnings are adjusted semi-annually for inflation. Dividends. Ordinary dividends are the most common type of corporate distribution. They are paid from earnings and profits of the corporation. They are considered qualifying dividends if the stock is held for 60 days and the dividend is issued by a U.S. corporation. Dividends are not considered as qualifying or taxed at the ordinary income rate. Corporations issuing dividends or brokerage firms holding stock investments for taxpayers are required to classify and report the amount of qualifying dividends to investors. And so here you receive a statement in order for you to properly account for your dividends. Non-taxable distributions. So they are not paid from a corporation's earnings or profits, are a return of taxpayers' original investment, are not included in taxpayers' income, and reduce taxpayer basis in the stock. Capital gain distributions. When stock reaches a zero basis, further distributions are taxed as capital gains, and this is reported on page 1 of your Form 1040 or Schedule D of your Form 1040. Current tax rate for dividends. So qualified dividends are taxed at rates ranging from 0 to 20%, possibly included in the 3.8% net investment income tax. And so these rates are lower than the rates for ordinary income. And if you refer to the table on 219 for qualified dividends and long-term capital gain rates. Reporting interest and dividend income. So interest income, generally interest income greater than $10 must be reported by a payer to a recipient on a Form 1099 INT. And so taxable interest from each payer is reported on Schedule B, Form 1040 if interest is greater than $1,500. And so tax exempt interest is reported on line 2A of Form 1040. And so you'll use a 1099 INT to key your information into your tax return if you use the software or just on paper. And so the dividend income is reported on the 1099 DIV. And so generally dividend income greater than $10 must be reported by a payer to recipient on Form 1099 DIV. If more than $1,500 in total ordinary qualified dividends are reported on Schedule B, capital gains dividends are reported on Schedule D of your Form 1040. Municipal bond interest. Taxpayers may exclude interest on state and local government obligations from their gross income. After tax return for a tax-free bond is calculated as follows. And so your actual after-tax return is equal to the tax-free return divided by 1 minus the tax rate. And so interest rates on municipal bonds generally reflect the after-tax return that compensates high-income taxpayers. So for an example, Gopal is a 32% federal income tax bracket and invests in a Nashville city bond paying 6%. What taxable interest rate will yield the same after-tax return as the municipal bond? And so here the calculation is 0.06, which is the tax-free return, paying 6%, divided by 1 minus 0.32, which is the 32% of federal income tax bracket. And so here the answer is 8.82%. Gifts and inheritances. Inheritances are excluded from income. Any income received from property after transfer is taxable. And so gifts received are excluded from income. A gift is defined by the courts as a voluntary transfer of property without adequate consideration. Gifts in business settings are usually considered taxable income. If a recipient renders service for a gift, the amount is taxable. Scholarships. Scholarship amounts spent for tuition, fees, books, and course-required supplies and equipment are excluded from income. Must include scholarship amounts in income for any amounts applied to room and board, any amounts received as compensation for required work, including work-study programs. So those are exceptions. Alimony. In order to be considered alimony, payments must meet the following requirements. So a payment must be made in cash and received by the ex-spouse. A payment must be made under a decree of divorce or separate maintenance or under a written instrument incident to the divorce. Payments cannot continue after the death of the spouse. Payments cannot be designated as anything other than alimony. And if parties are divorced or legally separated, they must not be members of the same household at the same time payments are made. And so prior to December 31st, 2018, alimony was deductible by the payer and includable in income by the recipient. The TCJA eliminated the deduction for alimony. Conversely, the recipient need not include alimony received as income. And so here they defined alimony in the requirements, but recent tax changes, the TCJA has changed it where it's not included right now, but that do understand that tax law is set to expire in a couple of years. So that's why it's still important information to know, just in case it becomes active again. Property transfers. A spouse who transfers property in settlement of a marital obligation is not required to recognize any gain as a result of the property's appreciation. Child support. Child support is not deductible by the payer, nor income to the recipient. It is an important factor, though, however, in determining which spouse gets the dependency exemption. And I think we went over that in the previous chapter 1 about dependency. Qualified tuition programs allow taxpayers to meet qualified higher education expenses by either buying in-kind tuition credits or certificates or contributing to an established savings type account, 529, things of that nature. Distributions are tax-free if used for qualified higher education expenses. And so qualified higher education expenses include tuition and fees, books, supplies, equipment, reasonable room and board costs. Qualified higher education expenses also include tuition in connection with enrollment or attendance at an elementary or secondary public or private or religious school. However, the use of specific term tuition excludes other types of qualifying education expenses, such as books, supplies, equipment for elementary and secondary students. Maximum exclusion for elementary and secondary education is $10,000 per beneficiary per year. If not used for this purpose outlined, distributions are taxable and subject to a 10% early withdrawal penalty. Taxpayers may claim American Opportunity Credit or Lifetime Learning Credit in the same year as a distribution taken for qualified tuition program on behalf of the same student. Distribution must not be used for the same expenses for which an education credit was claimed, and it must also reduce qualified higher education expenses excluded from income by scholarships, veterans, benefits, etc. Educational savings accounts. Taxpayers are allowed to set up educational savings accounts to pay for qualified education expenses. Contributions to educational savings accounts are limited to $2,000 per beneficiary per year. They are not deductible, are subject to income limits, cannot be made once beneficiary reaches 18 years old, cannot be made in the same year as a QTP contribution to beneficiary, and are phased out between adjusted gross incomes of $95,000 and $110,000 for single taxpayers and $190,000 and $220,000 for married couples who file jointly. Distributions are tax-free if used for qualified education expenses for college and private elementary and secondary schools. Qualified education expenses include tuition and fees, books and supplies, equipment, room and board. If distributions received during the tax year exceed qualified education expenses, part of the distribution will be treated as return of capital and part will be treated as a distribution of earnings. And so the distribution is presumed to be pro rata from each category. So the higher education expense deduction, this deduction has expired and is no longer available. So however, because the deduction has previously been extended multiple times, a summary of 2017 material is presented in the text. And so in 2017, taxpayers were allowed an above-the-line deduction for qualified tuition and related expenses incurred during the year. And these were the different rates at the different AGIs. So unemployment compensation. Unemployment compensation payments are fully taxable. Unemployment compensation is generally reported on a Form 1099-G. Social Security benefits. And so part of Social Security benefits may be included in gross income. So the maximum inclusion amount is 85%. Inclusion is based on the taxpayer's modified AGI. If the modified AGI plus 50% of Social Security benefit is less than the base amount shown below, benefits are excluded from income. So here you have a table that helps you define that. Also refer to the simplified Social Security worksheet provided on pages 34, 35, and 36 of Chapter 2 for how to compute the taxable amount of Social Security. So community property states. State law governs how income derived from property held by a married couple, either jointly or separately, must be allocated between the spouses. 9 states practice the community property system of marital law. And so under the community property system, all property is deemed to be either separate property or community property. Separate property includes property acquired by a spouse before marriage or received after a spouse is a gift or an inheritance. All other property owned by a married couple is presumed to be community property. Each spouse is automatically taxed on behalf of the income from community property. And so that's the end of the lecture. Please read Chapter 2 and review the PowerPoint. This lecture, pretty much, we try to cover gross income, and the items that either need to be included or excluded from gross income. Thank you.